Up until this point, we focused on preparing the data correctly. We've seen that Bitcoin's prices are asymmetric and dominated by extreme events. To compute value at risk and conditional value at risk, we first need to make an assumption about the distribution of returns. This is where a lot of models break down quietly at the start, because we make that assumption that most of them are normal distributions, bell-shaped curves with thin tails. And so to model this distribution, we went ahead and created a new file called distribution.py. In the code, this is exactly what fitNormal function does. We take the historical log returns and estimate the mean and standard deviation using the maximum likelihood estimate. Conceptually, we're asking if Bitcoin's returns were normally distributed, what bell curve would fit that data best? But we already saw a problem earlier that Bitcoin prices don't follow a normal distribution, and we have extreme events and crashes that happen way more frequently. We saw that excess kurtosis at a 9. That's not a miscalculation, that's a warning sign. And so this is why we decide to use student t distribution. The student t looks similar to the normal distribution near the center, but it has much heavier tails. In practical terms, it aligns more probability to extreme gains and losses, exactly what we observed in the Bitcoin market. In fit student t, we call t.fit on the log returns to estimate location and scale, and most importantly, the degrees of freedom. That degree of freedom parameter is doing the heavy lifting. Lower values mean fatter tails and more extreme risk. As the degree of freedom increases, the student t smoothly collapses back to a normal distribution. So instead of assuming risk away, we let the data tell us how heavy those tails really are. Alright, so now in our main, what we do is read in those log returns, print out some summary statistics like the length, mean, and standard deviation. We then fit those log returns to the normal distribution student t distribution and print out the summary stats for each of the models. Let's go ahead and run the code now and take a look at variables that we get. Okay, so we can see we have 4.6k returns, the mean a slightly positive drift, and the standard deviation of 3.75. For the normal distribution, we have 0.139%, and for the student t distribution, we have 0.16. So the student t distribution is basically saying that it thinks the mean is slightly above what the normal distribution is saying. For the standard deviation, the normal distribution gives a relatively similar answer here, but for the student t, we actually see that it drops to 1.9%. That doesn't mean that Bitcoin suddenly gets less risky. It means that student t is allocating more probability to the tails instead of spreading it out evenly across the full distribution. Now, the real point to pay attention to from the student t distribution is the degrees of freedom. We can see here that it came in just over 2, and that signifies extreme results. Values below 5 already imply high tails. So far, everything has been metric-based, but now let's get into some visualizations.